Hello, and welcome to our introductory video about binary options. In this video, you'll learn the basics and advantages of trading binary options. We'll also go over briefly how to begin trading these option strategies. Let's get started. First, what is a binary option? Well, we need to understand traditional options. An option in finance is the right, but not the obligation, to buy or sell a security at a specific price on a specific date and time, known as the expiration. There are two types of options, call options and put options. Call options are the right to buy or call away the security, and puts are the right to sell or put the security. Buyers of both call options and put options pay an amount upfront called a premium in exchange for the option rights. The premium represents the maximum loss for the option buyer. At expiration, the buyer chooses whether or not to exercise the option based on where the underlying is trading. In the case of a call option, the buyer's payout is the difference between the price of the underlying asset at expiration and the strike price of the option. Buyers of call options are taking a bullish view on the underlying because the strategy makes money when the underlying goes up. As you can see from the chart, the more the underlying goes up, the more profit to the call option buyer. If the underlying is below the strike price at expiration, the buyer loses his entire premium or his entire investment. Similarly, a put option's payout is the difference between the strike price minus the price of the underlying asset at expiration. Buyers of put options are taking a bearish view on the underlying because the strategy is profitable when the underlying goes down. As you can see from the chart, the more the underlying goes down, the more profit to the put option buyer. If the underlying is above the strike price at expiration, the buyer loses his entire premium or his entire investment. A binary option is a specific type of option that, as the name implies, has a binary outcome. That is, only one of two things can happen. For binary call options, if the underlying security is above the strike price at expiration, the option pays out a fixed amount. If not, then the buyer loses his premium. As you can see from the chart, the outcome is all or nothing, and the buyer does not make more money if the underlying goes up more than the strike price. Binary puts work the same way, except that they express a bearish view. If the underlying security is below the strike price, the option pays out a fixed amount. If not, the buyer loses his premium. So why would a currency trader want to use binary options? It's very simple. Currency pairs are not tremendously volatile. In order to earn big profits, you need to risk a large amount of capital trading them on a short-term basis. Trading traditional options requires large moves in the underlying to earn big profits. Binary options allow you to earn profits that are multiples of your invested capital with only a small move in the underlying asset. Valuing traditional options can be very challenging. Buyers need to determine not only whether the asset will be above or below the strike price at expiration, but also by how much. There are complex formulas such as Black-Scholes to help buyers determine the probability distribution of the underlying price at maturity and therefore the expected value. By contrast, a binary options trader only needs to determine the probability that the underlying asset will be above or below the strike price at expiration. By developing a diversified portfolio of binary options, the trader can grow his account if he makes successful bets on the majority of his trades. There are some additional features that can be added to binary options to increase the payout to the buyer. These features are called Onetouch and No-Touch. In a one-touch binary option, the option pays out if the asset touches the strike price at any time prior to expiration, regardless of the price at the time of expiration. In a no-touch option, the option pays out only if the asset does not touch the strike price at all prior to the expiration. In this chart, you can see an example of an asset which has touched the strike price but is currently trading above the strike price. If this were a one-touch or a no-touch option, the fate of the option would already be known, regardless of the price of the underlying at expiration. For a one-touch option, the option would absolutely pay out, and for a no-touch option, it would not pay out, because the asset has touched that strike price. This concept can be expanded to a double touch or a double no-touch. In a double touch or a double no-touch binary option, there'll be two levels, one above and one below the asset price. The asset will need to touch or avoid both levels in order to pay out. So now that we know what binary options are, let's talk about how to get started trading them. The first thing to do is to open an account with a binary options broker, such as Bank Day Binary. I suggest you open a demo account to practice trading before you put your capital at risk. Once you see that you can make money trading these binary options, you will of course want to start trading real money. Here you can see part of the trading screen from Bank Day Binary. You'll need to select the asset that you want to trade. Binary options typically expire at 3:30 p.m. on the same day and are struck at the current level. You select the direction you think the asset will move, up or down, and the dollar amount you want to risk. We suggest that you risk a relatively small portion of your account, 5% or less, on each trade, and make 20 or more trades in a given day. The market will tell you the payout you'll receive if you're correct. Then you simply wait for the option to expire. The mechanics are quite easy. The challenge is in selecting the right assets and the right direction. That is where we come in. We can help you understand trends and develop profitable strategies using our binary options trading guide.